Hi, everybody. I would like to introduce you to Tara Krieg. She is our mortgage broker that we work with very extensively, and she has been so helpful to our clients. And we have so many clients right now that are concerned about interest rates. They're asking us questions about should we refinance? What's the best solution? How does this process work? We've had a lot of misinformation out there, people thinking that just because the Fed has zero or negative rates, that their rates are going to be zero or negative. So we just want to make sure that our clients are informed. And I thought you were probably the best person to do that. And so I just wanted to share for a few minutes. Tara, if you could give us a little of your background and help fill us in on some of these mortgage and interest rates.
Sure, I'd be happy to, Meredith. Thank you. So again, my name is Tara Krieg. I'm a senior loan officer with AmeriFirst Financial. I'm also a branch manager and a personal financial coach with the Dave Ramsey organization, and have been in the business about 18 years. So really enjoy what we do in helping families use their mortgage as a financial tool, rather that's through eliminating debt to pay off their house or acquiring investment properties or whatever that is. We really help our families sit down and figure out how the mortgage fits into the bigger plan.
Good. That's terrific. Terrific.
Yeah.
So tell us a little bit about what's the process? What do you look for if somebody calls you up and says, hey, should I refinance or should I not?
That's a great question. So first of all, I have to find out what the motivation for the question is. And so for a lot of our families, if they've had a reduction in income, if they're concerned about their employment, it might be that they want to set themselves up to have an emergency reserve in the event that were to happen. You know, they want to make sure that their family is secure. And so especially in these times with the pandemic, I've actually had some clients who have gone from a 15-year fix to a 30-year fix with a similar rate. They're going to continue to make that 15-year payment, but they're just concerned that if there's a reduction in income, they want the flexibility of making a more affordable house payment. And then in other cases, I have clients whose jobs are very secure and have taken advantage of this opportunity to reduce their term with a lower interest rate to keep their payment very similar to what they're paying today. With a 10-year run of appreciation here in Arizona, a lot of families have been able to consolidate high interest rate credit card debt and just reposition themselves across the board. So for us, the big question is, how long do you plan to be in the house? What are the hopes with this refinance? Is it about saving interest over the long run? Is it about, paying down debt or just increasing affordability?
That's great. That's great. So how does one determine and say, okay, I heard interest rates were X and I'm paying Y. When should I call you?
That's a really good question. So first of all, I want to address the fact that there's a lot of misconceptions about interest rates out there right now. The Fed's announced a while back that they cut the Fed funds rate to nearly zero, and I got all these calls and emails that said, I hear interest rates are zero. I want the 0% interest rate. So that was the Fed funds rate. It impacts short-term borrowing. If you have a home equity line of credit, you most likely saw a rate reduction with that, which was wonderful. Auto loans have very low rates right now, but it does not directly impact long-term interest rates. So long-term interest rates are actually directly tied to mortgage-backed security bonds. And what has caused rates to be as low as they are today is the feds are actually participating in a program called quantitative easing. So they are buying mortgage-backed security bonds to keep interest rates low to help the economy during this difficult time as we're recovering from this pandemic and an increase in unemployment. So rates are very good. Speaking to that, 15-year fixed are in the mid-2s, 30-year fixed are in the low 3s to 3%, depending on your product. If you're in a government loan, it's going to be even less than that. I'm locking FHA and VA loans as low as, on a 30-year fixed, as low as 2.5% to 2.75%, which is just unheard of. Amazing, amazing interest rates. But be really careful. There's a lot of bait and switch out there. Your credit score, your loan to value, if you're taking cash out, if it's your primary home versus your investment property, all of these things make a big difference on the score that's being offered. And there's an online lender who is notorious for quoting really low rates, but charging several discount points up front. And, it's not to say that paying discount points up front isn't wise, but we would need to know the motivation to do that. And I think, Meredith, you'd agree, it needs to make sense. Does it fit in your long-term and short-term goals, because for some of these families, they're going to be making a move in 2 to 3 years. So we're looking for an immediate savings, but we're not looking for a long-term investment. So really taking into consideration the borrower's short and long-term goals helps us put together a refinance recommendation that makes sense for them and their family.
That's great. That's great. So at this time when a lot of people possibly were laid off, their income may have been reduced, or they're maybe getting subsidized with different programs that are out there during this COVID-19 situation.
Yeah.
How does that affect their credit? How does it affect what they're going through now? And how does it affect them being able to get a loan?
Yeah, I'm really glad you asked. So the forbearance program is probably what's most familiar to people. And when they announced that as a part of the CARES Act, they said that individuals who have been affected by COVID-19 financially could do a deferment, or it's forbearance is the exact word, on their mortgage. And the problem with that is a lot of people didn't understand it. So they thought they could just skip payments and then resume normal payments. And at the time it was rolled out, the way it was presented is actually that they would skip 3, 6, or up to 12 months of payments, but then all those payments were due. And so obviously there was a lot of concern about that. Fannie and Freddie have since come out and said it's their intention to offer alternatives to a lump sum payment like a deferment, but it will cause a waiting period for a borrower who's looking to refinance or purchase a home. And so as of this moment right now, it is June 10th, because it changes all the time, it is 3 months from the completion of that forbearance if you had to defer that payment to the end of the loan or alter the terms in any way. If you're currently in a forbearance and you want to refinance or purchase and you have the means to pay the outstanding balance today and bring that account current and get out of that forbearance, there actually would not be a required waiting period. Whereas before they were saying rather you reinstated the loan fully or hadn't even skipped the payments, that it could be 12 months was the initial waiting period that was being thrown around. And obviously there was a big outcry because consumers weren't being told that. They just would call and the banks would say, yes, you can skip your payment, no problem. And then they would call us to refinance and we would say, oh, I'm really sorry, you're not eligible. And so if you have participated in one of these forbearance programs, it's very important to partner with a lender who can properly advise you on what the potential consequences of that are, both good and bad.
That's terrific. That's good information. I think a lot of people were not aware of all of those little nuances, and nothing comes without some strings attached.
Yes,
this
is
no
very
free money.
Yeah, I also want to touch on, Meredith, for the self-employed individuals who chose to take advantage of the PPP loan. So that was that payroll protection program that the government put out. Actually, the Fannie Mae and Freddie Mac have indicated that we have to consider that payment in the borrower's debt-to-income ratios, because there's no guarantee it's going to be fully forgiven. They're saying that it's likely it will be forgiven if they meet all these requirements, but as a lender, we don't know if they're going to meet the requirements. And that debt did not exist on the prior year's tax returns, and so it's a new liability to the business. And so we now have to take into consideration that payment, if not forgiven, into the qualifying ratios, on top of having to get a year-to-date profit and loss statement for that business and a balance sheet. Because as you can imagine, a lot of these small businesses have just been adversely affected by this COVID and the shutdown of their businesses. And so if we're using tax returns from 18 or 19, it's very likely that their cash flow looks different today. And so they want to make sure that we're not writing mortgages for borrowers who don't have the income today and no guarantee of how quickly it will resume its normal levels for some of these businesses, especially in restaurants and things of that nature that are, I think of restaurants and spas, even nail salons, everything's at 50% capacity. So I think it is going to take several years really before we see the full employment come back.
Right, I agree. What about any businesses where, let's just say that they were employed and they decided not to go back to work based on their choosing, that they would rather stay unemployed. How is that affecting some of these borrowers?
We are not able to use unemployment as a source of qualifying income. And I have had individuals who are calling me saying, hey, I'm actually making more on unemployment than I was making on my job. I'd like to buy a house. And unfortunately, we have to let them know that, we're not able to do that. The CARES Act has a deadline for that you get unemployment, which is a percentage of your income. And then right now, as part of the CARES Act, you get money on top of that. That's obviously not something that's long-term. When we're looking at a client who's going to be obtaining a 30-year mortgage, we're looking at the longevity of the continued income, and unemployment is certainly not stable enough to consider.
Good. Well, are there any other issues that you have seen or questions that you have heard that I'm not even asking?
Well, I think the biggest thing is that lenders are really having to use more due diligence today to approve a borrower whose income could be questionable. And so we have lots of borrowers who are returning to work after a period of being furloughed. Maybe they claimed unemployment for a period of time, perhaps their hours were reduced, and now they're back to work. And so the lender has to determine, are they back to work indefinitely? Are they back to work at a period of time where it's really reasonable for us to use that income? And so the employer has to confirm that, yes, they are back full-time, 40 hours, whatever that is. And if there's been a reduction of income that has not ended yet, and in a lot of cases there are, where maybe for the rest of the year, all employees agreed to take a 25% pay cut. That is not uncommon right now, just to stay employed. And so we would have to qualify them at that reduced dollar amount as opposed to what they have earned this entire time. And I'll give you an example. I had a nurse who worked in a surgery center, and as you know, elective surgeries were canceled for months. And so although she's a nurse and you wouldn't think that she would be impacted by this, her hours had been cut to the point that she was going to have to claim unemployment. And now they've opened up those surgery centers again. Of course, they're not doing as many surgeries because there's more restrictions, but she is returning to work. And so we need to see over a period of time how her income is going to come back. If she starts out at 15 hours and then goes to 25 hours and then 32 hours, we just need to know that it's likely that that will continue.
Right. Well, those are all really, really good points. And so I've learned a lot this afternoon. That's good. This whole epidemic or pandemic has really caused a lot of chaos, and it's more the trickle-down effect of what's been happening and what we've all been seeing out there. So thank you, Tara. I appreciate it so very, very much. I appreciate it.
You are welcome, Meredith, and thank you so much. And if you have any questions or concerns, or any of your clients have any questions or concerns above and beyond just providing a loan, we'd love to be a resource, and we're always happy to do that free of charge.
And you've always been great at that. Thank you. Thank you, Tara.
You're welcome. You have a great day.